Owning a home in India. It's the big dream for so many of us, right? But what you might not know is that your dream home can also have some serious tax implications. Now, don't worry, it's not nearly as complicated as it sounds. Today, we're going to pull back the curtain on the tax rules for property owners, and we're going to make it all super simple and clear. Let's dive in. So, you've got a property. Awesome. But here's the million-dollar question. Do you really know how the tax man looks at it? Because how you use that property, whether you're living in it or renting it out, completely changes the game. And honestly, getting a handle on this is absolutely crucial for your financial health. Think of it like a fork in the road. The tax rules basically split your property's journey into two completely different paths. Path 1 is for a self-occupied property. That's the one you call home. Path 2 is for a let-out property, the one you rent to someone else. We're going to explore both, starting with the easier one. All right, let's start with Path 1. This is the one most of us are familiar with, the home you actually live in. And the good news? The tax rules here are pretty simple and, honestly, quite rewarding. So, what exactly is a self-occupied property, or SOP? Simple. It's the house you own and live in. But here's the catch, and it's a big one. You can't have rented it out at any point during the year, not even for a month. That one little detail can change its entire tax status, so it's something you really need to watch. And here is the absolute best part about being a homeowner who lives in their own place. For tax purposes, the income-generating potential of your house, what they call the gross annual value, is considered zero, nil, nada. Why? Well, because the government sees that you're not making any actual income from it. It's a simple but really powerful benefit. But wait, it gets even better. Even though the government says your house has nil value for income, they still let you claim a deduction on the interest you pay for your home loan. We're talking up to 2 lakh rupees a year. It's basically a little helping hand from the tax department for buying a home. Okay, so that was the homeowner route. Now, let's switch gears and walk down Path 2, the landlord life. This is where you're turning that property into an income stream. Yeah, the math gets a little more complex here, but don't worry, it all follows a pretty clear step-by-step logic. Think of this as your recipe for figuring out your taxable rental income. It's really just 3 main steps. First, we've got to figure out that gross annual value, or GAV. Then, you subtract any municipal taxes you've paid. And finally, you get to take a couple of really nice deductions to get to your final taxable income. That's the roadmap. Now, if there is one number you absolutely have to get right in this whole thing, it's this, the gross annual value. This is the bedrock of the entire calculation. And here's the twist. It's not always just the rent you collect. It's a special figure calculated in a very specific way. So how do we find this magical GAV number? It's basically a face-off. On one side, you have what the tax authorities think you should be earning, called the reasonable expected rent. On the other side, you have the actual rent you pocketed. The gross annual value, it's whichever one of those is higher. Let's dig into that. Okay, let's unpack this reasonable expected rent. It's a bit of a comparison game between a few numbers. The municipal value, the fair rent for similar places, and this thing called standard rent. Now look closely at property B. See how its municipal value is pretty high. But the law caps its expected rent at that lower standard rent figure of 84,252 rupees. That's a super important rule that could save you a ton in taxes. All right, on to step 2, actual rent received. Sounds easy, right? But what happens if a tenant just doesn't pay? That's what we call unrealized rent. And yes, you can deduct that from your income, but, and this is a huge but, you have to jump through some very specific hoops first. And these are the hoops. It's not a suggestion box. You have to meet all 4 conditions. The rental agreement has to be legit. The tenant who didn't pay, they have to be gone. They can't just be squatting in another one of your properties. And you have to show you really tried to get that money back. We're talking maybe even taking them to court. It's a high bar for a reason. So let's see how this all comes together. Check out property A. The owner only got 8 lakh in rent, but because the expected rent was higher, the tax department is going to use that bigger number, over 8.4 lakh, as the GAV. Ouch. But then look at property C. The owner actually made more than expected, so their actual higher rent becomes the GAV. Remember, it's always the higher of the two. Okay, once you have your GAV, you subtract municipal taxes, and that gives you the net annual value, or NAAV.
From there, you get two fantastic deductions. First, a flat 30% off the top for upkeep. Doesn't matter if you spent more or less, you get 30%. And now, for the big one, the real game changer for landlords, the interest on your home loan. For a rental property, you can deduct the entire amount. No 2 lakh rupee cap, nothing. This is a massive, massive benefit. All right, we've got the main roads mapped out. Now let's explore some of the tricky side streets and those interesting what-if questions that always seem to pop up for property owners. Here's a fun little curveball from the tax code for you. Did you know you can be treated as the owner for tax purposes even if your name isn't on the official deed? It's a concept called a deemed owner, and it's how the tax rules make sure people can't just shuffle properties around to avoid paying their fair share. So when does this happen? Well, say you gift a property to your spouse or your child without really getting paid for it. The tax man still looks at you as the owner. Same thing if you're part of a co-op housing society or you have a really long lease, like 12 years or more. It's all about who's really benefiting from the property at the end of the day. Now, what if your rent covers more than just the 4 walls? Like, what if it includes furniture or other services? That's called composite rent. The rule is pretty simple. Can you separate the rent for the building from the rent for the extras? If you're renting a furnished apartment, sure you can. So you tax the building part under house property and the furniture part separately. But if you're renting out, say, a fully equipped movie theater, you can't really separate the rent for the building from the rent for the projector. It's a package deal. So the whole thing just gets taxed as business income. Phew, that was a lot of ground we covered. So let's just boil it all down. What are the absolute must-know, non-negotiable takeaways that every single property owner should remember from all this? Here's your cheat sheet. For the home you live in, your annual value is nil, and you get that sweet 2 lakh rupee deduction on your home loan interest. For rental properties, it's all about the GAV, which is the higher of what you should be earning and what you are earning. And the biggest prize for landlords, there's no limit on deducting your home loan interest. Oh, and a crucial tip. You have to pay the municipal taxes yourself to claim them. Don't let your tenant pay them for you. And really, this is the bottom line. This isn't just about paying taxes. It's about being smart with your finances. When you really understand these rules, you can structure everything to make your property work so much harder for you in the long run. So, I'll leave you with this question. Now that you've got the basics down, take a hard look at your own property portfolio. Are you really making the most of these tax rules? Are you maybe leaving money on the table? With just a little bit of planning, you can turn that property from just an asset into a really powerful tool for building your wealth. Thanks for tuning in.